For years, pensioners in the United Kingdom have been told to save for their future, to put away money for retirement so that when they stop working, they can enjoy a comfortable life without constant financial stress. Yet today, a growing concern has surfaced that is leaving many older citizens anxious and even a little confused. The focus is on those who have more than £3,000 in savings, because reports are spreading that HMRC is looking more closely at pensioners who fall into this group. On the surface, £3,000 does not seem like a fortune, but the way rules and thresholds are set up in the UK means that having savings above this level could impact entitlement to certain benefits, change how much tax might be due on savings interest, and eventually influence eligibility for additional support from the Department for Work and Pensions. For many pensioners, this news is both worrying and frustrating because it feels as though they are being penalized for doing exactly what they were encouraged to do throughout their working lives. To understand why this matters, we need to look closely at the system of benefits and taxation that surrounds retirement. In the UK, the state pension is a foundation for older people, but for many, it is simply not enough to cover all living costs. That is why additional support exists in the form of means-tested benefits such as pension credit, housing benefit, or help with council tax. These benefits are designed to provide extra financial relief for those who are on lower incomes, but the amount a person can receive is directly influenced by how much they have in savings. The rules generally allow a small amount of savings without penalty, but once savings rise above certain thresholds, the benefits can start to reduce. Traditionally, that threshold has been around £6,000, meaning someone with savings below that level would not see any reduction. Once they cross the 6,000 figure, the government assumes they are earning extra income from their savings, even if the interest rates are extremely low. For every £500 over 6,000, a small amount of income is assumed, and benefits are reduced accordingly. This is why the sudden attention on £3,000 is causing alarm. Many pensioners are asking themselves whether HMRC is preparing to lower the threshold, or whether new rules are about to kick in that will make even modest savers subject to benefit reductions or extra tax scrutiny. Imagine someone who has carefully put away a few £1,000s for emergencies like boiler repairs or medical expenses. They may have felt secure knowing that this small nest egg would not interfere with their ability to claim pension credit or other support. Now, however, the message seems to be that even those modest savings could come under the spotlight. The fear is that this represents a broader policy shift, where pensioners are once again asked to shoulder the burden of tightening public finances. Of course, it is important to clarify that simply having £3,000 in savings does not automatically mean someone will pay more tax. In the UK, the majority of pensioners are protected by the personal savings allowance, which means they can earn up to £1,000 of interest tax-free if they are a basic rate taxpayer, or up to £500 if they pay the higher rate. With today's interest rates, a pensioner would need far more than £3,000 saved in a standard account to even come close to that limit. So why the noise about this figure? The answer lies in the way HMRC and the DWP share data, and the fact that starting in April 2027, banks will be required to share the national insurance numbers of account holders directly with HMRC. This will make it far easier for the authorities to cross-check savings balances, identify individuals who may be exceeding allowances, and ensure that no interest slips through untaxed. In practice, the policy is not creating a new tax on £3,000, but it is increasing the level of monitoring, which understandably makes pensioners feel uneasy. The frustration grows when we consider the mixed messages pensioners receive. On one hand, financial advisors, the government, and charities consistently tell people to save whatever they can for their retirement. On the other hand, when those savings actually exist, they can end up reducing entitlement to benefits or triggering tax questions. It feels like a lose-lose situation for many. If they spend their money, they may run out of funds in later life and struggle to cope with emergencies. If they keep their money in the bank, they may find that they are punished through reduced benefits. This tension creates real anxiety, particularly for those on the edge of the benefit system who rely on every pound to make ends meet. Stories have already emerged of pensioners considering whether they should spend down their savings simply to qualify for higher benefits, a situation that is both illogical and deeply unfair. Consider the case of Margaret, a 73-year-old widow who spent her life working part-time and raising 3 children. She receives the basic state pension and relies on pension credit to help with her living costs. Over the years, she managed to save about £4,000, money she set aside slowly through careful budgeting. That money gives her peace of mind in case her washing machine breaks or she needs dental work. Yet now she is hearing reports that HMRC might view her savings as excessive and that her benefit entitlement could be affected. For Margaret, this feels like a punishment for responsibility. She did not take expensive holidays or live beyond her means. She simply prepared for the unexpected. If the rules change in a way that targets her savings, she is forced into an impossible choice between security and income. This is not just about individual stories. It reflects a wider debate about how society treats older people. The UK is an aging population, with millions depending on the state pension and related benefits to survive. At the same time, government finances are stretched, and HMRC is under pressure to collect every pound of tax that is owed. That combination often leads to policies that, intentionally or not, place extra burdens on pensioners. It is politically sensitive because pensioners vote in large numbers. But it is also morally sensitive because these are people who have already contributed to the system through decades of work and tax. They are not asking for handouts. They are asking for fairness. And fairness means recognizing that a few £1,000s of savings does not make someone wealthy, nor should it undermine their right to basic support. To be clear, the main financial impact of savings comes through means-tested benefits rather than direct taxation. For example, the pension credit system is designed to top up income for those with little else to rely on. However, if someone has savings above the threshold, their entitlement may be reduced or even eliminated. Housing benefit and council tax support follow similar rules. The assumption is that people should use their savings before turning to the state for help. In theory, that may sound reasonable, but in practice, it creates real hardship. Savings are meant for unexpected expenses, not for covering everyday bills. By forcing pensioners to dip into savings to survive, the system erodes the very safety net they worked so hard to build, and once those savings are gone, the pensioner is left more vulnerable than ever. This is why financial advisors often recommend using ISAs as a more effective savings vehicle. Money in an ISA grows tax-free, and while it is still considered capital for benefit purposes, the tax advantage at least helps preserve value. Unfortunately, many pensioners are not aware of how ISAs work, or may not have easy access to the right accounts. They may simply keep money in a regular savings account, where it earns little interest and is more visible to the authorities. Education and guidance are therefore critical, but these are areas where the government has often fallen short. Pensioners are left to navigate a complex landscape of rules, allowances, and benefits, with little clear information on how to protect themselves. The 2027 changes will only make this more complicated. By requiring banks to collect national insurance numbers and share them with HMRC, the government is tightening the net. This is intended to reduce tax avoidance and ensure that savings interest is properly declared. But for ordinary pensioners, it feels intrusive. Many worry about privacy, data security, and the potential for errors. What happens if HMRC miscalculates, or if interest from a joint account is attributed incorrectly? For older people who may already struggle with paperwork and online systems, the risk of confusion and mistakes is high. That, in turn, can lead to stressful letters, demands for repayment, or benefit suspensions. The mere threat of such problems can be enough to cause sleepless nights. Critics argue that the government should be focusing its attention elsewhere. Large-scale tax avoidance by corporations and wealthy individuals cost far more than any underpayment of savings interest by pensioners. Yet, it is easier and cheaper for HMRC to monitor ordinary citizens than to pursue complex corporate cases. This raises questions of justice and proportionality. Should pensioners with modest savings really be the priority target when there are billions lost through loopholes and aggressive tax planning at the top end of society? The optics are troubling, and they contribute to a sense of betrayal among older voters. Nevertheless, pensioners are not powerless. By understanding the rules and making informed decisions, they can protect themselves from unnecessary losses. For example, spreading money across ISAs, using the personal savings allowance, and ensuring income is structured efficiently can all reduce exposure. Couples can take advantage of the marriage allowance, transferring part of a personal allowance to ensure less tax is paid overall. Small pension withdrawals can be managed to remain within tax-free limits. These strategies require knowledge and sometimes professional advice, but they make a significant difference. The key is not to panic, but to plan. At the heart of this issue is trust. Pensioners want to believe that the government values their contribution and will support them in later life. They want to feel that the system is fair, predictable, and transparent. When sudden headlines suggest that even a modest £3,000 in savings could make them a target, that trust is shaken. Restoring it will require clear communication from HMRC and the DWP, reassurance that pensioners are not being unfairly singled out, and perhaps a broader public debate about how retirement should be funded in a fair society. Until then, the uncertainty will linger, and pensioners will continue to wonder whether the very savings they rely on for security could become a source of vulnerability.